lunchtime live stream for you. Get the dice up there so we can all do the numerology to do your stock picks from. Today we're going to be talking about overproduction, malinvestments, the bullwhip effect, or even deflation. A lot of times we hear some of these things that are taking place with prices coming down, whether that is due to an actual deflationary environment where all prices are generally coming down, or if that is due to the bullwhip effect when you have an overproduction or a misunderstanding of where inventory levels should be in accordance to the demand that is out there. Now, if you take a look at some of the links that I leave down in the description, they're talking about solar panels, semiconductors. They're talking manufacturing from a typical area that you would see manufacturing that is now shifting over to other places due to the fact of the redistribution of the manufacturing base that is happening out there. But what really is taking place, and a lot of times when we see this, we don't necessarily understand that it is due to an overproduction or maybe due to a misunderstanding of where inventory levels should really be. And I know this is kind of confusing, especially when most people are just kind of looking for like a quick, simple answer to what's going on. It's not a simple answer to just kind of give out in a single sentence or something like that. It really takes an understanding of the multiple scenarios that are happening at the exact same time. So if you understand like the bullwhip effect, which is something that we have talked about quite a bit on this channel, when you have a shortage that has taken place, and it doesn't really matter why, right? I mean, it could be a self-inflicted wound like we had experienced during the pandemic. It could be weather related. It could be, all kinds of stuff that's out there. But whatever reason that takes place creates the shortage. When the demand starts to pick up, looking at that shortage saying, oh man, we really want this product, but it's not here. What do? Prices start to move up. Those who are manufacturing that particular product or whatever it is that is now in shortage really starts to invest into more production. We need to meet this demand. In order to meet the demand, we need to increase facilities, we need to hire people, we need to do things in order to bring more of this product to the market to meet this demand. Right? And this is what we experienced through a lot of stuff. Now, I recognized it very clearly within the lumber industry, and it happened quite fast. But other things within the economy, like these semiconductors, took time. Right? And it is something that I had actually stated in a video saying that when these semiconductor shortages turn into gluts, what's that going to look like? Well, here it is. We are starting to experience that very thing. Now, something that I found interesting about this whole scenario that was taking place with these semiconductors is that as I was reading the articles and talking specifically about China, China is ramping up manufacturing production of semiconductors during a time in which that there's already a flood of semiconductors. Now, this is something that I thought, is this a strategy or is this a misunderstanding or malinvestment? Like, what is taking place here? Well, if you think about it, if you are a manufacturer of these particular semiconductors or any product out there, it doesn't really matter what it is, and then all of a sudden the price of these things go up because there's a shortage out there, and the people who see those prices start to say, hey, I want to take place in that activity. I want to be able to manufacture semiconductors and take advantage of these high prices. I'm going to get into the production of this as well. Well, if everybody does that at the same time, guess what happens, right? Overproduction starts to take place. And so you're going to have failures, right? Bankruptcies. Well, if you are a major producer of these things and you want the market and you are getting flooded with other manufacturers out there, think about this strategy that China has taken on. They're creating even more semiconductors, right? So when this huge amount of new products starts to flood onto the market and the bankruptcies start to happen, China's going to lose a bunch too, but they have way more than anybody else. So as these businesses start to fail, and theirs will too, they're going to end up with the market share of it because these other ones won't be able to compete with the sheer amount that is coming out of China. Like, China knows this game. They are playing it very well. It's not like they're new to the understanding of the bullwhip effect or economic forces or anything else out there. They are very much positioning themselves to take advantage of a lot of the situations that are going to be coming from the bullwhip effect that starts causing prices to go down. And we're going to see it in a lot of stuff. So again, like the bullwhip effect is a misunderstanding of where inventory levels should be, but really it's the malinvestment that goes into it. It's not just like people going, oh man, we're in shortages, I guess we'll have to wait till like the manufacturers can bring it back. It doesn't quite work like that. Human greed looks at that and says, man, I see those high prices, I'm in it, I want to jump in on it as well. And that's really where the problem starts to manifest itself within the global manufacturing communities out there, as nobody knows exactly how much investment has moved into these products and then how much availability is going to be provided from all this manufacturing. And at the same time, the demand coming down dramatically due to, the efforts coming out of the Federal Reserve and other governments and whatnot out there to try and hurt the demand that has taken place to bring that inflation down, or that price inflation down. So again, like we can look at it and say, oh man, this is like, deflationary scenario that's coming from the Federal Reserve and the lifting of interest rates, or we can look at it from a distribution network supply side of things and then understand that this is left over from the situation that was taking place during the pandemic that created the shortage that forced the investment into these products now. All right, so let's see here. 6 minutes into it. I hope you guys are enjoying this live stream. We have 78 people watching right now with 24 likes. I know we can get that up to at least 50 likes here in the next 5 minutes. All right, UE, bonjour. All right, sup, bro. Got the popcorn and soda right on, Dex. All right, hello from north coast of the Dominican Republic. Good morning, Simon. Good morning, everybody. All right. Parlez vos français? Français. All right. Let's see. GM Brody. Good morning, Brody. Let's see here. Calling 6 on the die. Howdy, guys. Wayne, you're planning on attending the Rebel Capitalist Live event this year? Hello, Simon. All right. Hey, EE, listening while wiring a house in Roseville, California. Very cool, man. All right. God bless everyone in the chat. Okay. Oh my, who's on the DR North Coast? Oh, the Dominican Republican North Coast. Right on. Well, it's good to see you guys up in here. And again, thank you very much for hitting that like button as you're coming into the live stream. Understanding what's about ready to take place within the economy is going to be very difficult because there's a lot of stuff that I'm already starting to see come up within like things that I don't even have to do with the bullwhip effect or anything. But one of them that I just, thought I'd just mention out there and seeing is that a lot of people are looking at like the repo facility, like coming to an end, or the possibility of it, the shrinking amount of like activity taking place in repo. A lot of people say that this is going to create some major issues. Even the Federal Reserve came out and said like they don't even know why there even really is a need for a repo facility. And now understanding what has taken place over the last few years and growing so accustomed to having the repo facility at the disposal for a lot of these banks to either park cash or even swap treasuries for cash with, a lot of people kind of look at this repo facility in like a permanent standing thing, like this is the only tools that they have. Well, that was during an abundant reserve system where they had ample reserves. If they go into a limited reserve system, this would be the way that they had operated prior to the pandemic, right? I mean, it was like prior to September of 2019 even. So it would really be a returning back to the way that they used to do things. And instead of establishing the Fed funds rate at an account at the Fed, it would be established more in the overnight lending rate between the big banks, which is more of like a market participation, finding that level. Now, again, the Federal Reserve does manipulate the interest rates at the big banks' overnight lending rate by buying and selling treasuries off of those big banks and adjusting the levels at these big banks. But still, that's the way that they operated in the past. And for, like I read these articles saying, oh man, the Federal Reserve is going to be out of this Fed and they won't have any control or anything. And I'm like, well, of course they're going to have, they're going to have control over the interest rates. That's the way they had it before the repo facility was set up. But I think the bigger question from it is that what happens to the liquidity out there, right? If the Federal Reserve is not there providing the liquidity to these banks are going to freeze up and they won't be able to provide loans to anybody. This is the big question that happens out there when they say that the repo facility is coming to an end, right? But even on that, it doesn't really make a whole lot of sense when you consider that the Treasury Department has already stated that they are going to be there to provide the liquidity to these big banks by doing the bond buyback. So if they ever came into a situation in which that nobody wanted to buy those bonds, or they're having a problem with the bond market being liquid, the Treasury is going to be there saying, no, man, it's liquid. You don't have to worry about the Federal Reserve buying these things. We're going to buy them back from you and provide all the liquidity that you need. Now, I don't see a lot of people using that argument when they talk about the repo facility or the repo facility coming to an end. Very few people bring up the bond buyback program. In fact, I don't ever see any economist talking about it. I'm the only one I see talking about it. And there is the occasional one. If you go and Google it and search it out, you will find there is some articles that some people are, talking about that bond buyback program, but they don't incorporate it into anything of the strategy of what's coming here in the next few months to a year or whatever. Anyway, just thought I'd bring that up. I guess that's probably for another video. Means, do you speak French? I don't speak French, to which the correspondent is no. All right. Because everyone's just making content, dude. Well, I don't know. Is everybody just making content? Like, I mean, I think about some of the things that people are putting out there as far as some of their content. Like, when everybody was screaming inflation and hyperinflation, and I was like one of the lone people out there saying this is all going to come to an end, and you're going to find that the inflation scenario or the hyperinflation scenario was very misunderstood, and that the prices would come down and, all that other stuff. It was very difficult for a lot of people to see that, especially when you would get a lot of attention by screaming hyperinflation, government's going to kill you, everything is going to come to an end, you are going to die, right? By putting out videos like that, you can get a lot of attention, right? I mean, a lot of it. And you can put together some pretty good factual evidence that really, describes that particular event very well, like a hyperinflation scenario. I mean, everything, like all the evidence could line right up for it. Right? Here's the problem with that is that by doing that, how is it that you can explain what is happening now? Right? This is like, you can like, oh man, well, nobody saw this particular thing, and this is the reason why everybody saw it as a hyperinflation scenario before, including, whatever. People can put up these excuses for it, but ultimately, wouldn't it be the guy who's just like, no, this stuff will come to an end if you just follow lumber and notice that the things that are taking place within lumber, the reestablishment of the distribution network, the demand coming in line with supply, all the stuff that would make prices normal occurred. Like totally occurred within lumber, right? And now I do understand that there is a lot of issues within the building supply industry. Like, I mean, I know I'm part of it, that didn't have prices come back down to the way they were. One of them is plywood, right? Plywood is a very close product to like framing lumber. It should kind of follow the same prices. If it's going down, then lumber's going down. Everything can kind of go down together. But plywood doesn't seem to be reacting quite the same as dimensional lumber does. The only difference that I'm finding with plywood is that the production of its counterpart, OSB, which is a similar product to plywood, that it gets used in the same fashion, but it's manufactured a little differently, had come up in extremely short supply. OSB is the more popular product for sheathing. Since it's not available, they have to move over to plywood. Plywood prices move up. It's due to the fact of OSB not being in as much manufacturing as taken place prior to the pandemic. I mean, I did a video at the end of 2019 talking about how they were going to be pulling hundreds of billions of square feet of production off the market. Now, that makes sense to me now why plywood is higher than it normally should be. It doesn't have to do with the money printer. It has to do with availability. That's the difference inside of it. I can see this stuff. Like, I mean, I'm starting to find hardware, like nails and screws, coming from different places than you would normally get it. Like, China was always the manufacturer and distributor of like hardware, right? But now I'm starting to find nails coming in from places like India, like places I'd never seen before, right? I mean, I've never gotten gun nails from India, right? But now these products are starting to find their way in. And that's due, again, to like the bullwhip effect and Cantillon effect. If you understood what both of those ones are, then it makes a lot of sense, right? When the prices moved up extremely high, right? Due to the lack of availability out there, people were scrambling around to try and source out whatever they could from wherever they could. And if it ended up being further distances and buying a cheaper product because that distance and that cheaper product made up for the fact that the prices are moved up, now became available that never was available before, right? And these things are starting to occur within itself. Anyhow, moving on here. Okay. How to determine that imaginary neutral rate? Well, if you follow R-star, the Federal Reserve does do like an idea of where they feel that R-star is, or the neutral rate, but it's not something that's set in stone. Like it's no, like I don't think there is any real time like indicator that shows where neutral interest rate is. I think you could probably establish that after the fact, and you take the data and you know calculate it all out. You could probably figure out where the neutral rate was in the past, but where it is at this exact moment, I think that's very difficult to try and figure out, because a lot of it has to do with the inflation expectations coming from the future. So if the inflation expectation changes, then so will the neutral interest rate. And so that really, a lot of it now becomes perception of what the Federal Reserve feels inflation expectation is going to be in the future, right? Instead of like what it is right now. And there's no controlling inflation expectation. So a lot of this stuff makes it very difficult. It's just like, man, where is it? How do you figure this part out? I guess my point to what I look at, or what I feel about the neutral interest rate, is that it does exist, right? And if it's moving up or down would really be more important than to know exactly where the level is, because that exact level is probably not exactly accurate, because there's no way of determining that, right? But if the neutral interest rate is rising while the Federal Reserve is maintaining, then that means the restriction is becoming less. And that's probably what I believe is occurring right now. And one of the reasons why the Federal Reserve is very like standoffish on saying, hey, we're going to be lowering interest rates going into the future. Just the simple idea of the neutral interest rate rising all on its own would then make the Federal Reserve's position less restrictive if the neutral interest rate is moving all on its own, right? And how they can get the neutral interest rate to move all on its own without the Fed actually doing anything is through market perception, right? Oh, inflation's going to be down in the future, don't it? You know, whatever. Just put out that narrative, and that will start to adjust the inflation expectation, and then in turn the neutral interest rate. Did I say all that right? I mean, if it's not already confusing, I think I just made it more confusing. All right, 112 of you up in here. Love seeing you. Why is... It seems like a couple of these comments are really small and in a different color. Why can't I see this? Do I have my glasses here? I don't have any glasses. Shoot. All right. Hank, thanks. Hank, that's a large part of the Fed's job. All right. Hey, all-nighter. Right on. See dishes up in here. Spending less than you make. All right. Life is inherently risky. There's no such thing as protecting yourself. All you can really do is mitigate risk. Red Robin is correct. Okay. Happy thoughts. Red Robin, I am having a hard time seeing your comment in here. Information there's about diversify investment. Have you attempted to read anything? What is that first part? I can't read what the first part of the question is. Oh, well. All right, solidarity comes from recognizing where your financial vulnerabilities are and strengthening those areas. Yes, John Rusher, mitigate risk. Made total sense, dude. Thank you. Did you say you think the Fed is hinting at actually raising rates further? I didn't hint at that. That's what Michelle Bowman just said in a speech given November 28th, 2023. I mean, so we're talking, what, not even 6-7 weeks ago, right? And in this speech, where did she say it in here? It seemed like it was towards the very beginning of this speech that she was saying that limit the committee's ability to respond. Okay, hold on here. One central one central topic of discussion during the FOMC meetings in 2018 and 2019, my first year as governor and permanent voting member of the FOMC, was how monetary policy strategies and tools could best achieve the committee's dual mandate of price stability and maximum employment in a world of structurally low interest rates and deflationary forces that kept inflation persistently under the 2% target. Relatedly, there was ongoing concerns that the federal funds rate, the FOMC key policy rate, was too close to the zero lower bound, which would limit the committee's ability to respond effectively to adverse shocks by lowering interest rates. So much so that even during the economic expansion, there was concern that the Fed would likely be severely limited in its ability to stimulate the economy. That's not the part that I was looking for, though. Well, sorry guys, I can't find in here where she was saying that it was her base case that they would have to raise rates going into the future. But that is what Michelle Bowman said in this particular speech. But I can't find where she said it in here, so it doesn't really mean anything anymore, does it? Yeah. All right. Well, I don't want to keep you guys here just with dead air while I try to figure that thing out. But I will find it and I will talk about it in Wednesday's live stream. So if you really want to know more about what Michelle Bowman was saying within the reflections on the economy and monetary policies, I am going to do a review of this entire speech on Wednesday. Join the live stream. It's a members only live stream, but it's well worth joining the membership. You have access to all the other membership videos, member only videos that I do. And it's only $1 a month, so it doesn't cost you anything, but it does give you access to those live streams in which that we have a very close community of people who are very serious about understanding these topics. They ask very good questions. The questions that you do ask of the community do get answered within the chats. They're some of the funnest live streams that I believe I have done. I put good energy, or I feel like good energy into it when I'm doing it. I do a lot more research when it comes to doing those live streams because I feel like charging you for it means that I have to provide you even more value. So it's a very good, in my opinion, a very good informative live streams that are not filled with a bunch of fluff and crap. They're actually filled with good information and breaking down and making the understanding of it a lot easier for the average person or just for anybody. And I found that it doesn't really matter what level of understanding in economics you really are. I have people who are CEOs of major corporations all the way down to the person who is just like, man, I'm just trying to figure out what the hell this stuff is all about. All levels are welcome and find benefit within these live streams. Not only do you get a good understanding of what has taken place within the economy, but then also understanding it on a level from a working class point of view gives us an advantage that a lot of people don't realize we have. We live in real time the data that a lot of these people are looking for to do their investments. We have it firsthand. Right? But a lot of us don't recognize it because we don't understand the macroeconomics that are happening out there. We don't understand, a lot of the stuff that really is economic forces like the bullwhip effect or the Cantillon effect. And since a lot of us don't understand it, we look for excuses. We end up blaming it on politics or blaming it on, other places. But really, if we understood it for what it is, which is truly economic forces, and these politicians and the banks and everybody else is just interacting or reacting to these things, wow, you can really figure this stuff out for yourself, and then you don't feel confused. In fact, you don't even feel worried about the future or anything else like that. A lot of times people say, what benefit does this have for you? Living life in a much stress-free environment, right? You understand, most of the time, a lot of stress comes from just simply not knowing, being worried about what the future has, right? That right there can be a very stressful experience. Am I going to be able to make my house payment? And my job is going to continue? Am I going to be able to do all the, everybody is very concerned about these things. And then we leave that up to the expectations out of politicians to make it right. Or even worse, we feel that there's some sort of thing that can be taken place out there that's going to make it good for you or something like that. Unfortunately, it just doesn't work like that. There's never going to be a time in life in which that it is going to be perfect for you. Like there's no politician out there, there's no anybody out there who is ever going to create a situation that says, man, this is like awesome for you. Right? So it's best to understand this stuff for ourselves, and that way, whatever decisions that they make, we know already what we're planning on doing. We don't have to worry about what they've done. All right. Do you prefer a Fed that is big and strong or is small and tight? I don't care. Like, to me, I am not one to judge whether or not the Fed should even exist, right? I don't care. Like, I mean, if you want to eliminate the Fed, get out of the Fed, go back to a gold standard, I'm cool. I'm down for it. Let's do it, right? Cryptocurrencies, I got it. Let's go for it, man. I'm down, right? I am not here to promote or advocate for central banking. I don't care, right? That's not for me to even put my concern about. What I'm worried about and what I'm attempting to do is try to figure this stuff out so I can position myself in the best place I can be. I can't change the Fed. I can't change the way the situation is. There's nothing we can do to do that, right? I mean, we might be able to rally and organize and promote and do all that other stuff and try and vote. Okay, that's great. Not going to happen, right? I mean, I don't see it happening. But what I do see happening is that they are going to continue on with their with conducting themselves the way they do. Same thing with the politicians, and same thing with all the rich elitists and all the other stuff. I mean, we can wish and hope and beg for them to change. They're not going to, right? It's not up for us to say, hey, you need to change the way you do things so that I can have a better life. That's not the way it's going to work, right? So regardless of the Fed, if it exists or doesn't exist, if it was big or small, it's inconsequential to me. I don't care, right? That's not for me to care about. Right? What I do care about is making sure that I position myself in an appropriate fashion, considering some of the things that they are doing. If they grow big or small, disband, continue on, go to a gold standard, go to crypto, whatever it is, that's fine. I mean, I'm not going to be one to say like, oh man, my whole life is over because of this. I'm going to adapt, right? I'm going to change to that. Rates will go up. There is no doubt. They pivoted since. All right. Why are some of these comments so small? I can hardly read them. Simon, your continued insight, dedication, and breaking it down for us. Live show. All right. Well, thanks for being here. I don't understand why some of these comments are not like highlighted. I can't see them. All right. Employment's still hot. No room to cut rates. I believe that's the same. I believe that too. Can the markets really withstand further hikes? How can they do that without kicking things into full-on recession? Well, that's a very interesting question there, Brody, because most of the time we end up getting stuck in this idea that the Federal Reserve and the level of interest rates and where they are is impacting the economy in a way that is like it hurts the economy, right? But that's the meaning that most of us give it, because that's how we understand like the interest rates. When the Federal Reserve raises interest rates, that's going to be painful for the consumer, right? That's how we kind of look at it. But very few, or not very often, do we ever like take into consideration that higher interest rates is actually good for the economy. It takes time, but it's a better position to be in, because then you have a return on capital investment. So if you have low inflation and high interest rates, I mean, that's actually the best position for an economy to be in. I mean, you think about it. I've used the analogy many times that, back in the early 80s, if you had lent your money, $1 million to the United States government, you would have a return of like, 15% yield or something, like 150 grand a year. That's a hell of a lot of money you could return back into the economy, both through investments or purchases or whatever it is you got going on. Well, now you invest $1 million with the U.S. government, you get a 5% return. It's like $50,000 a year. It's hardly anything. Like, I mean, don't get me wrong, $50,000 a year, a lot of money, right? But it's not like, like having $150,000 a year back in the early 80s. Right? So this is one of the problems with an economy that is operating at very low interest rates, being close to the zero lower bound and having a low neutral interest rate, is that the return on capital investment actually becomes negative. Right? So you lend money to the government. By the time you get it back, it has lost the purchasing power greater, right, than what it is that you have in return. So basically, your return on your capital has gone negative. You can't purchase as much with your money, even with the interest rate that you had gotten off of it. You can't purchase as much as if you had just instead of lending the money to the government, just made the purchases right then, right? You lost purchasing power over time, and that is really where a lot of the economy was positioned prior to the pandemic. I mean, Dr. Lacey Hunt was talking majorly about this exact scenario. And then really when you think about some of the issues that the Federal Reserve was facing with low interest rates and being close to that lower zero bound, they had no more room. They run out of scope, right? Not the mouthwash, but ran out of the ability to actually drop interest rates to stimulate the economy. All these low interest rates, neutral interest rates, all that other stuff was very damaging to the economy and was slowing it down dramatically. It's actually higher interest rates that is a benefit to the economy. So this is something else that a lot of times, this is the misunderstandings that end up taking place, is that if you have an economy, right, not one that's being manipulated and all that other stuff, just kind of set that all aside for just a second and just think about the economy holistically and say, okay, interest rates are either high or low. Right? If they are low, what that means is that there is not a lot of economic activity taking place out there. Right? The people who are lending money are searching for a place for people to borrow it. That's why the interest rates have gone down so far. And the people who are typically borrowing money aren't borrowing it because they don't want the material. They don't need the money to buy the material in order to do transactions, in order to participate in the economy. Right? This is literally how it is. Now, this is difficult for a lot of people to realize because most of the time when we see interest rates go down, we think about a major amount of economic activity happening out there. But if you think about it from the free market position, which is truly existing out there, those free market forces exist regardless if people think they do or don't, right? I mean, there is the government and Fed and everybody else manipulating and interacting with it, but those forces still exist out there. Right? So if the true economic forces that were really existing out there were allowed to be, then you would see that higher interest rates that are hitting the economy, or if the economy is being faced with higher interest rates, that means that the people themselves are very eager to borrow money so that they could get the material to participate within the economy. And that's when you see higher interest rates. Higher interest rates is a signal of a very active, functioning, hot economy. Low interest rates is the exact opposite, a very slow, inactive, not a cooled down economy. And that is very like trying to wrap your head around that part of it is very difficult, because most of the time when you see the Federal Reserve lowering interest rates, boom, you get irrational exuberance taking place and everybody's buying stuff that they shouldn't be buying at a higher price, right? Does all that kind of make sense? I don't know. All right. So I guess that's to the answer to that question. If further rate hikes given time, in my opinion, would actually be a benefit to the economy, right? And cause things to actually increase. All right, guys, I don't have too much more time here. Let me see, what time is it? I got about 5 more minutes, so I'm just going to answer another question or two, and then we're going to call it quits. All right. Once you go ZERP, you can't go back. All right. Simon, you might consider buying an iPad or something so you don't have to shuffle through papers. You can just have a PDF and you want to, that's kind of funny that you bring it up, Brody, because I actually went and dug out my ThinkPad. This was sent to me by a viewer. I don't know if he's still watching or anything. This thing is a tank, man. It's awesome. Anyway, so I started downloading some stuff on there and I started using it a little bit, but I'm not terribly comfortable doing it yet, so but I'll get to it and I'll start using that a lot more. All right, question: is the collapse coming this year? I think the collapse is already occurring. I mean, if you think about it, look at the amount of transactions that are happening within home sales. This is probably one of the biggest indicators of things that are happening out there. The lack of sales that are taking place is the collapse. Okay, that is the collapse. If there is less homes transactions taking place out there, think about this. Homes are the number one production item, manufactured production item here in the United States. It's almost 100% American made, American labor, American input. Everything about it is United States American. Everything that goes into it generally stays here. I mean, sure, some of the fixtures, appliances, stuff like that, maybe not, but the bulk of a structure is generally American made, manufacturing base. So if you have less transactions taking place within real estate, that is a collapse. That is a collapse within the economy. Now, we're not seeing it in a sense that what we would have anticipated from history, because we are not sitting in the same situation that we had been in history, right? A lot of times when we want to take back in the 30s or back in the 70s or something like that, what we are considering back then is not nearly the same type of environment, especially when it comes to the way the new money comes into the system. We're not facing the same type of economy. There was a time we used to be a manufacturing base. We would produce stuff and sell it to the world, and the world would send us their money, and we enjoyed that living, right? We enjoyed the higher standard of living from being this manufacturing base, but we don't do that anymore, right? Instead, what we do is we issue out a lot of debt, and that debt brings in the new money, and that new money then has to purchase all the stuff from around the world to then send to us, right? And this is how this system is now operating. It's not one in which that we can go and become a manufacturing powerhouse again in order to bring this new money in. We are going to be issuers of debt until we collapse, and nobody's buying our debt anymore. See, we'll eventually get to a point. I mean, if the way I see it goes, we'll eventually get to a point in which that they will just be force feeding money into us. That force feeding of money will then be forced into a particular direction, which means that you have to buy these particular items, right? Or you're not. I wouldn't say you have to buy these particular items. You won't be allowed to buy these particular items, right? From this force feeding of money. And now this force feeding of money can then start sending manufacturing out to whatever part of the world that they want to, right? And I know it's really hard to kind of wrap your head around all this other stuff, but there's no way that we are going back to being a manufacturing base in order to bring that new money in. There is no way of bringing new money in without the issuance of debt, right? The moment that debt is no longer valued around the world, it's over, right? Now, at this point, I'm still pretty confident in the dollar. I'm still pretty confident in the U.S. debt. I'm not confident in it lasting forever, but I am confident in it lasting a year, maybe even 10 years, maybe even longer than that. When I see the BRICS nations are setting up debt due in dollars, that leads me to believe at some point in the future, they are going to have to sell their products for dollars. Right? How else are they going to get the dollars to pay their debts back? This is occurring right now. I don't know, guys. I mean, we're trying to figure it all out, right? Okay, I'm going to give it 2 more minutes and then I'm going to go. All right. Would you all kindly hit the like button? Yes, please do. We got 129 people up here with 75 likes. Let's get it to 100 before I end the stream, right? 25 people, go and hit that like button right now. Practice will make it easier to use the laptop. Yeah, for sure. And I'm going to do it because I can get a lot more information, and then also I could probably highlight it and find those, the particular phrase that I'm looking for, like Michelle Bowman's one here, which I can't believe I can't find it, because it seemed like she had said it, right towards the very beginning of this damn thing. Anyhow, we're going to break it all down here on Wednesday. So join the live stream. There's a link down in the description of this video. You can go to the homepage of the channel. There's links there. Join the channel membership. It's $1 a month, $12 a year, $120 a decade, $480 for a lifetime of hardcore research, bringing it to you twice a week, hours at a time, dedicated to the understanding of this, dedicated to breaking it down so everybody can understand it. There's very few people out there on the internet who I believe is doing this. I'm unique, right? I'm unique for doing this. And whether or not it's an agreement that you have with me or not, it doesn't really matter. The information in here is coming straight out of the Federal Reserve. I would hope that you would take that information for yourself, to understand it for yourself, and then my opinion is just a little enhancement to that, right? That's really how this comes down. I love this stuff. Like I can't stop. Like I mean, even, even when I'm about ready to fall asleep and I can't keep my eyes open any further, I'm like, no, there's got to be one more article out there that I can read, right? I mean, I can't stop. So thank you for being here. Thank you for joining the channel. Thank you for hitting the like button. And thank you for all the support. Uneducated Economist, you let me know.